The ending stocks that I use are nominal. I've seen some fairly large numbers for India, but I don't know what the stock levels here would be. I always approach India as if we're sold out. I know that's a mistake, but I don't know how to do it any better than that. So there we're looking at a situation of supply being up, but demand being relatively strong with the crops being consumed where they're grown. So in summary, we're looking at a general increase in pulse area, stronger weather events around the world potentially. We've seen them the last couple of years. There's no reason to believe this is going to change. And I think that going forward next year and in the future for the next couple of years, India will lead any increases in pulse production output in the world. Thank you.
Thank you, Brian. I think those were some really good comments. One of the things that I would point out is that you definitely are seeing a wider end-use to grower price level now with the increases in the freight costs. And it's not just in the container freight, but you see it in the rail freight as well. And there's been a lot of frustration on producers' part when they see the FOB Vancouver levels versus the prices they're receiving today. But it's really just the market at work trying to allocate assets. That's right. So I think we'll hold all the questions till the very end and see if we can't get caught up somewhat here. So next up, Mr. Chandrasekhar from the Hindu Business Line will talk a little bit about global drivers in the pulse market.
Thank you, Mr. Chairman. Friends, I am truly delighted to be here this morning amidst a very distinguished galaxy of dignitaries. I've been asked to speak on global market drivers, agriculture market drivers, an outlook for 2014. Over the next 20 minutes, I'll try and take you through these market drivers and the outlook. Mr. Chairman, kindly signal me at the 18th minute, and then I'll try and wrap it up within 20 minutes. Thank you very much. Okay, let's look at what happened in 2010, 11, and even 2013. We had in 2009, 10, 11, and 12, some kind of weather events happening in some part of the world or the other. And it culminated in 2012 with the worst drought in 5 decades in the US Midwest. And all of us know how prices behaved in 2010, 2011, and 2012, whether it was corn or wheat or cotton or soybean, palm oil. All of us know how prices spiked, and governments across the world, both governments of the developed nations and governments of the developing nations, had to take a series of policy initiatives to control food inflation. And all of us have gone through those periods. 2013, last year, fortunately, the weather turned certainly benign across the world, and there was a huge rebound in production. The kind of incomes that the growers received in 2011 and 2012 encouraged them to do much better input management in 2013, particularly in the developed economies in North America and in South America. And obviously, there was a big rebound in agriculture production. And we all know what happened to prices. The world suddenly found itself handling too much of agriculture commodities. In 2013, prices have considerably softened, whether it is oil seeds or rice or wheat or coarse grains, corn, cotton, etc. When a commodity market is in surplus, usually speculative capital tends to stay in the sidelines. And that's exactly what happened in 2013. And therefore, the feverish play of speculative capital that the world witnessed in 2010, 11, and 12 considerably changed by 2013 because of the huge surplus that the world produced. And obviously, that also had a softening effect on commodity prices. Another important factor that we all need to understand, realize, and recognize is the role of liquidity. From 2009 onwards, in fact, after this 2008 global economic crisis, from 2009 onwards, all economies, all major economies of the world, including the US, Europe, China, and even India, started huge stimulus packages to revive their economies. And all of us know about quantitative easing 1 and QE2 of the United States, and which culminated in the QE3 in 2012. All this led to an extraordinary increase in the liquidity. And when you have excess liquidity, obviously, it leads to higher commodity demand and higher commodity prices. Now that liquidity is going to be tapered, and all of us know what tapering means. The the Federal Reserve is now going to start reducing its asset purchase. It's already announced a $20 billion a month reduction, and $85 billion purchase is now at $65 billion a month. And over the next few months, we can expect very clearly that the QE3 will come to an end, which will simply mean that liquidity available will reduce. And obviously, that will have a negative impact on commodity prices. And all of us are beginning to see that gold prices that were at $1,600 an ounce about, about 10 months ago are currently about $1,300. It actually came down to $1,200. The gold and silver price boom simply of the last 4 years was liquidity driven. And in a number of agriculture commodities also, there was a combination of higher liquidity and weather events which affected production. And I think now both these factors are beginning to soften themselves. We have had benign weather in 2013. I'm expecting a repeat of that benign weather in 2014, and liquidity that the world witnessed, excessive liquidity is obviously going to shrink in the coming months and in this year and the next. What do we expect in 2014? Let me jump to the conclusion first. I am looking at a fairly bearish market across agriculture commodities. I am not singling out pulses. I am across agriculture commodities, whether it is corn or wheat or cotton or sugar or soybean, palm oil. I'm expecting a bearish market, and I'll go into the reasons why I'm saying what I'm saying. Decent harvest for the second year running in 2014 that can be expected. And stocks are going to be replenished by major consumers. And these are going to drive markets across agriculture commodities in 2014. And this is going to be driven simply by oilseeds and grains markets across the world. More important, in 2010, 2012 period, those 3 years, high prices of agriculture commodities actually incentivized producers more in the developed economies to do much better input management. And obviously, we had a fantastic rebound of production in 2013, which is likely to repeat in 2014 too. And therefore, softer prices in the second half of 2013 onwards, which we have seen, obviously is again positive for consumers. I call these consumer-friendly prices. These consumer-friendly prices are going to help importing economies, consuming economies build a much bigger inventory. And therefore, stock building, I believe, is something of a very positive sign. What is the outlook? Very quickly, I'll run through. Corn market, for me, is looking bearish simply because of a very large rebound in supplies, both in US and in South America, followed by an anticipated large crop, which would probably be planted very soon and which will come out by August or September this year. All this is, of course, subject to normal weather, and weather forecasters have so far held the belief that weather in 2014 is going to be normal. Same with wheat. Wheat prices are going to obviously trend lower. They'll follow corn, and particularly that harvests that take place after July in the second half of the year. Winter kill obviously is an issue, but I think we still don't know the extent of damage that this winter kill could have caused. But there is belief that it's not going to be threatening. Cotton, again, in the short term, cotton, I see very clearly the fundamentals are constructive because of tightness in supplies outside of China, and there'll be stronger demand for cotton exports from the US. Therefore, cotton is one commodity I'm not too bearish about, very strictly speaking. But sugar, as we know, has been trading at $16 to $17 cents a pound, that's the level, and I see sugar market in a big surplus. At least in the first half of this year, sugar will continue to remain bearish. What happens in Brazil in June, July, August will obviously determine the future of sugar prices. Sugar surplus, the large surplus, will certainly shrink this year, and next year maybe sugar could get into a deficit. But that's next year, not this year. Soybean, again, I'm finding the fundamentals as tight as that of grains. I have brought soybean here particularly because of the legume connection. Soybean is protein, pulses are protein, and obviously they are fighting for market share for protein consumption. Very large South American crop of soybean. In the US, one can expect again a big rebound in the US Midwest over the next few months. Chinese demand, of course, is strong. Soya oil consumption is not going to increase dramatically because of the mandate in the US, unchanged mandate for biofuel in the US. Soya meal demand is going to increase because of larger livestock demand. Therefore, there'll be more crushing of soybean, and therefore there'll be more availability of oil, which could potentially pull down soybean oil prices. And therefore, whether it is corn, wheat, or sugar, or the entire soya complex, I don't see an opportunity for a price rise. If there is a directional change in prices, it will be to the downside and not to the upside. So therefore, 2014, we should expect, I track a number of weather forecasts, and so far there has been no threatening forecast as far as 2014 global weather is concerned. But we must remember, I am fond of saying the world is just one El Nino away from a major disaster. We don't know when that will strike, but hopefully, and God willing, I think it will not strike us this year. And therefore, that's again one more reason. An assumption that the world will enjoy benign weather conditions in 2014 again makes my outlook what it is. That's bearish. The US, after a lot of uncertainty in 2013, the US Fed has finally decided in December last that tapering will start. They have already reduced twice $10 billion asset purchase, and this is likely to continue. And that, I believe, is a strong signal for the US dollar to strengthen, very simply because tapering would not take place unless the policymakers are convinced that the US economy has bottomed out and economic growth is now beginning to gather pace. And that's, again, a very good sign for the world. Geopolitical situation. There's a strong relationship between global food inflation and crude oil prices. Crude oil markets certainly affect food and affect inflation through the biofuel route, through the synthetic fertilizer route, through enhanced transportation costs, etc. And fortunately, over the last 3 or 4 months, the world has found that the Iran standoff has also eased considerably. There's an interim arrangement with Iran. And therefore, the geopolitical instabilities that characterize the crude market over the last 3 or 4 years are a lot more stable now and expected to remain stable over the rest of the year. And therefore, again, with this very limited, extraordinarily limited appreciation potential for agriculture commodity prices, I expect that the speculative capital, particularly the long-only funds in the US and other economies, are going to stay off agriculture commodities. And therefore, that's also going to have a kind of softening impact on agriculture commodity prices across the world in 2014. But the FAO food price index, we saw a note about a fortnight ago. In January, for the first time in 3 months, was much lower simply because of cereal, sugar, oil, and meat prices softening. Lower prices are by themselves not bad at all. It may probably upset the producers a little bit, but lower prices are certainly stimulating demand. And they're stimulating demand in